This is TreppWire Week in Review for week ending October 27th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, stocks surged after the GDP numbers for Q3 surprised to the upside. In other data, more slowdown was evident in the housing market, with new home sales dropping and price gains shrinking. And in earnings, big tech has been a disappointment. But in other sectors, results are better than feared. Manus, we're on the doorstep of the Fed meeting next week. How do you think the Fed will interpret the mixed data this week?
I think we're rapidly reaching a point where there will be diminishing returns from continuing to push rates higher. I think that we're seeing enough turbulence in the markets, even though stocks were generally up for the last 8 or 9 days, that I think there'll be a lot of pressure on the Fed to tap the brakes with the pace at which they're going higher. I think most people believe it's going to be 75 basis points this month. The Fed came out late last week and hinted that future interest rate hikes could be more measured after the November one. That set off a huge stock market rally on Friday, spilled over into earlier this week. There was a stretch where we saw, I think it was 5 out of 7 days where stocks were up enormously and risk was back on. It really felt like we were back to early June or late July in terms of risk on. That being said, I think that there's a lot of turbulence. We saw some really miserable tech earnings this week. The economy is slowing quite rapidly in certain areas. Used car prices are coming down. Rents are starting to level off. Companies are starting to talk about layoffs in big numbers. The amount of sublease space, something we've talked about extensively over the last 6 months, has grown. And I think there's enough turbulence there that if the Fed were to do 75, I think that might be considered an overshoot. I may be a real contrarian here, but given the amount of things that we're seeing, weakness in China, FX issues with the pound and the yen, talks about illiquidity in the treasury markets, I wouldn't be completely blown away if the Fed did 50 in November and not 75. I think that makes me an outlier, but I think we're starting to see the impact of these higher interest rates.
Yeah, so the GDP number came in 2.6% annualized over the period against estimates of 2.3% growth. So I think, as Martha alluded to in the lead-in, exceeded expectations in terms of GDP. This is in spite of the Fed's increases, in spite of inflation numbers that also beat estimates. The economy still seems to be, pushing out. Manus, you hit on a few areas of deceleration, spending on cars, parts, foods, and beverage, but third straight quarter in which goods spending fell. So there's definitely a squeeze that's starting to be felt on consumers. But if you look at exports, it seems like trade deficit narrowed with a steep drop in imports. So, it'll be interesting to see how that, matriculates across the economy now that's been put out there. Comments from San Francisco Fed president, kind of echo the sentiment Martha talked about, where, that she was quoted as saying, this is Mary Daly, find ourselves with a 75 basis point increase in November, but things could change after that. I don't think you're necessarily taking a contrarian stance of maybe saying a 50 and a 50, Manus, just because what I'm seeing, maybe it's just where I'm at in life and being more attached to the markets. Maybe it's just this new modern 24/7, 365, social media that we have access to real-time data. But it seems to me that nobody really knows what's going on. If you read the news every day, you wouldn't know any more from yesterday than you did 2 days ago or today relative to yesterday, because these Fed presidents say, yeah, we're going to be very hawkish, and you would assume the markets would react negatively. Markets go up, GDP comes in higher than expected, and we're acting like the Fed's going to back down on rates. So at this point, I wouldn't be shocked to see anything happen. I think, we're kind of living through this in real time, and nobody really has a blueprint. To get some of the more economic notes here, U.S. home sales data for September showed that home sales had fallen 10.9% from the previous month. Home prices are still higher than they were a year ago, but the gains are shrinking at the fastest pace on record. So prices in August were 13% higher nationally compared to August of 21. That's according to the CoreLogic Case-Shiller Home Price Index. That's down from 15.6% annual gain in the previous month. On a month-over-month basis, cities on the West Coast, San Francisco, Seattle, and San Diego fell the most. So I think if you're a listener of our podcast, we've had a lot of sublease stories and a lot of discussions around San Francisco and Seattle specifically. And I think the residential market kind of acts as a proxy for those CRE marketplaces. And we're starting to see those residential markets really tell the tale. So maybe there's more distress on the CRE side coming. And then another interesting footnote on the housing market this week, Atlanta-based home builder Pulte Group reported Tuesday that canceled deals spiked in the third quarter and orders plunged as demand faltered. What was really interesting here was that contracts were canceled in about 24% of their deals in the third quarter. That's up from 15% in the second quarter. So purchase contracts on the whole fell 28% from a year earlier. So that missed the estimate of about 5,700 transactions. They had 4,900 in the third quarter. So we're starting to see this play out in real time. Another interesting takeaway from that was there was some commentary around home buyers that had put up earnest money deposits. When they cancel those contracts, they walk away from those earnest money deposits. And in some instances, they're fairly sizable. So we're starting to see people, feel so strongly that this is the wrong time to buy that they're actually leaving some money on the table. So while those builders are having contracts canceled, it's not 100% negative news for them in the sense that those earnest money deposits remain with them. Last thing on the housing market, mortgage rates topped 7% for the first time in more than 2 decades. So the last couple of weeks we've been flirting at about 6.9%. Looks like this week they finally eclipsed 7%. So I saw some research right before we came on put out by John Burns and Freddie Mac that said at 7% interest rates, it excludes an additional 24 million home buyers from qualifying for a $400,000 mortgage loan. So if you want to start quantifying what is the impact beyond just the payment and the math part, you're really starting to reduce potential home buyer pools when the interest rates and the prices still remain at the levels that they're at right now.
It would be interesting to know out of those cancellations what the breakdown is percentage-wise of people that couldn't qualify for a mortgage because the rate is higher and they can no longer meet the needs to service their debt, or just basically not lent to. And what percentage of those think that the market is now 10% lower? Because in New York, that's what you put up, right? You put up a 10% down payment, and that's, you forfeit that if you just walk away without some kind of contractual clause in there, right? An inspection or some other element. But if that percentage is high of the people walking away, then you're basically saying that people think that they were paying 10% more. Probably they probably wouldn't walk away if they thought the market was 10% too high. It's probably more like 15 or 20% buyer's remorse at that point. So it'll be interesting to see if anybody can put out some research on that front. Let's turn it back to a couple of other things we were talking about, why I think this, might be an inflection point here in terms of interest rates. And this is kind of spitballing a little bit because I'm not somebody that really gets into the weeds when it comes to the inflation numbers. But the recent 3 months, give or take, have shown that CPI number to be in that 8.5 range, give or take, right? A little higher, a little lower, but 8.5%. For us to still be at 8.5% a year from now means we're going up another 8% from where we are today, right? But if cars, if homes, and if rent come in at zero, if there is no growth there, or if that growth is 1 or 2%, to get to 8%, you would have to have things like food and energy go up 16%, right? To get to an average of 8, right? And I do think that if we're fast forwarding to a year from now, you have to think that this housing and this autos and other things, and the fact that while having ticked up recently, has not raced up like it did last year, some of that should be reflected in the forthcoming months. And that will take some of the pressure off the Fed to really keep, the pedal to the metal, as it were, with interest rate hikes. So that's where I'm coming from with this. I think it's somewhat encouraging in the narrative of the Fed being able to have a little room to wiggle here, that we have seen some of this price pressure come off.
If we dig a little deeper on some of those macro data points, what are we looking at?
Well, it was a really, really interesting week. If all you do, if you're a casual market follower and just follow the Dow every day, you probably would have thought this was a pretty good week, right? Most days the Dow was up. The Dow was up, I think, 1,500 points over a 3-day stretch. And even today it was up, even though tech earnings have been really, really shockingly depressing this week. But it's really been a bifurcated market. And the way I would look at it is the old school economy has done very well. We saw this week that McDonald's, Honeywell, and Caterpillar were among the really sizable beats, and they were rewarded with big jumps in their share prices. But on the tech side, shares were obliterated in many cases. Amazon today on Thursday, I guess it's 1027, 1028, just came out. Weakest growth in Amazon Web Services on record, disappointing earnings, stock down 20%. Facebook yesterday, Meta, basically growth was zero. They're going to look to reduce employment costs by 20%, stock down 25% today. Microsoft, weaker than expected guidance. I guess they're kind of in between old school and new school. They've been around so long. Their stock down sizably after that weaker guidance. So a very, very rough week for, what used to be called the FANG stocks, right? Now it's, we have Meta instead of Facebook and Alphabet instead of Google. So maybe it's the MANA stocks now, but, they were obliterated. And so it's a tale of two cities, right? Old school stocks and the Dow surging, tech stocks getting blown up and falling 15, 20% in several cases. And it shows, I think, that under the surface, there's a lot more turbulence than maybe the casual market watcher may see.
Yeah, I think, it's interesting if you dig a little deeper, even within the tech companies, man. It's Meta reported quarterly profits were down by more than 50%. Their Reality Labs division, which is where their VR headsets are, lost over $9 billion in the first 3 quarters. They warned that the fourth quarter is going to be more of the same. I think I read somewhere that said over the last year they've invested like $15 billion into that endeavor and really no results. I mean, there are a few articles in the last couple of weeks talking about, them thinking they were going to have, I want to say it was 500,000 users per month, and they've downgraded those estimates to 250,000. But the reality is some of those virtual worlds actually have less than 50 people actually going to them. So really interesting time. I think, for me, I don't know a whole lot about that, but Zuckerberg has lost so much of his personal net worth based on him like doubling down on this. I think this is going to turn into one of those things where either he's going to come out looking like a genius even more so in 10 or 15 years, or it's going to be one of those instances where, somebody had all the power and all the money and they just ran it into the ground. So I don't know which side of that coin I'm on, but to this point, it doesn't look great for them. And then I think, Microsoft was interesting too. They actually topped expectations, but had slow growth in their cloud computing business, disappointing fourth quarter guidance. And so they had the biggest one-day drop since March of 2020. So to your point, a lot of negative news coming out of the tech companies. I guess, we're very familiar with the CRE space, and we say that pricing has kind of gotten out of control and values have maybe gotten a little bit outside of the realm there, and we're going to see a correction. I guess, you could ask the same question here. Were these companies ever really worth that, or was it really loose monetary policy and consumer spending on ads and other things on their platforms that were really driving those prices up when maybe there wasn't enough true demand in the market to support those? And we're seeing just a correction here and not really just a crash. Maybe they had been propped up through the last 10 years when really the value wasn't there.
Well, it's interesting that, I have a thesis that kind of came to me today, and that is that for some of these old school companies that have really weathered the last 6 months very well, and that would include the companies I named before, plus the banks that really outperformed earlier this week. This crisis or downturn or whatever you want to call it right now is not their first rodeo, right? They've seen downturns over and over and over again. And I think when you have that history, you tend to hire more slowly. You tend to take on space less aggressively. It's not complete risk on. You're kind of shepherding your assets for another day. I do think that when you're one of these high-flying stocks and you've never seen adversity, you don't kind of build for necessarily the most detrimental times, that, the highest headwinds. And I think for the first time, Amazon and Alphabet are facing a situation where advertising growth is going to be slower. The need for Amazon Web Services may not be as intense as it's been in recent years. And I just don't know, without going through some growing pains, that they can resize without enduring more pain.
Yeah, I think that's like, there was some stuff this week. We've been hearing about some of these tech companies slowing hiring, Manus. But if you look at what Google's done, they added 12,000 employees in Q3, which brought their total headcount to about 186,000, which is doubling what they had 4 years ago. So to your point, I mean, kind of unprecedented growth in terms of headcount. You don't know necessarily. I mean, I would argue at this point that those additional people probably haven't contributed revenue on par. And so you're going to have to see some layoffs. So I think, back to your thesis of maybe the Fed taking a little bit less hawkish approach going forward. The shoe that hasn't dropped that I think is going to and has to is these layoffs starting to happen. And I think we're really going to see the impacts of that potentially first in the multifamily space. If a lot of these tech employees get laid off, LinkedIn, Facebook, Alphabet, et cetera, we've already seen a little bit slowing demand in the multi side. That could really accelerate some of that slowing demand.
Yeah, I mean, there's a huge multiplier effect from all of these companies in the areas that they are headquartered or have grown into, right? It used to be Amazon, Seattle, right? Other companies, Palo Alto and Mountain View and stuff like that. But these firms have spread their tentacles everywhere, and they tend to lift markets. Washington, D.C., obviously Arlington, in the case of Amazon, they lift the markets enormously in terms of demand for housing, restaurants, fitness centers, hotels, everything. So just like they can lift a city on their back with their demand, the other side of the coin is they could drag a city down when those layoffs come. And we can only hope that these impacts are modest.
So the question on our listeners' mind is, what is the impact of all of that to commercial real estate?
Yeah, so I think we've been talking a lot about what interest rates mean, what this higher cost of capital environment means. We've seen a slowdown in transaction volume. We haven't seen a commensurate slowdown in price, although there's been a slowdown in pricing. I think what we've talked about, though, there's a little bit of a disconnect between like the harsh reality that's probably coming and what we're seeing right now. A slowdown, lesser transactions, like those are not actually inflicting real pain, because most of the people that are having to sell now at a slightly reduced price, effectively reap the benefit of selling a previous asset into that market and 1031 into that deal. So, what I'm a little nervous about is if these things continue to go the way they are and we start seeing layoffs and people start losing their job, or inflation doesn't start showing some signs of major relief, we actually are going to start seeing real distress. Like when we see consumer distress, when we see people out of work, when we see jobs slowing, unemployment going up, if you look at the strategic oil reserve and where we're at now relative to the last 25 years, like there's some real risk there. I think I read something this week that says we're down to about 25 days worth of diesel supply. If any or all of those things start to falter, I think CRE is going to face a really brunt reality. Because at this point, if you're 3 years into a loan that has another 3 years, on the note, as long as you're cash flow positive, the higher interest rates don't affect you today. And what you're hoping for is that the market turns and interest rates come back down. It comes time for you to come out of that deal and into a new one. Really, the impact today is just on people that are facing that maturity deadline now. And, those are going to be a small number on a relative basis. So if people start dealing with slowing demand on the apartment side, or offices, tenants stop paying their rent, which we haven't seen at this point, that's where the real distress is going to be. I don't know necessarily that's going to happen, but I think, for everything we can say in terms of the positive news on the economy and everything else with GDP, there's a lot of these other things that are just kind of hanging out there as a storm cloud that if they actually start to happen, my thesis would be negative very quickly. So that's kind of where I'm at. I think we're still strong, and I think there should be sense of optimism in the market on the whole, but I don't think you should be blindly optimistic, because there's still several things hanging out there. There's just one or two of them actually come to fruition. We're going to see some detrimental impacts in the market very quickly.
So I tried to list the things that I saw this week and bucket them into reasons for optimism and reasons for pessimism. And I'll let you guys react to this when I'm done. On the optimism side, in the CMBS markets, we did see some new deals come. We saw both SASB and a conduit come to market. Brookfield is going to use the CMBS market to finance their watermark purchase, which is a big deal. I think there's about a $3.8 billion deal. So in that regard, markets are functioning. And in a couple of minutes, if people want, I can get into where spreads are these days. Sales transactions continuing to take place, although at a slower pace. There's been a leveling off of interest rates, which should restore some confidence to the market. The 10-year Treasury was down 30 basis points this week. The 10-year is back down to under 4%. And liquidity is still quite plentiful. A lot of guys out there with dry powder, and people have been willing to jump in on dips at much smaller dips than they would have in the past during past crises 40, 30, 20, and 10 years ago. So those are the reasons for optimism. Reasons for pessimism, the pace at which firms are giving back space is really, really alarming at this point. And that's not just alarming for the office REITs that are out there. They certainly will be impacted. Boston Properties this week, even though they beat on FFO and on earnings, they did warn that they thought the office market was still in for more turbulence. There would be more vacancies and more declines in income. But those givebacks also will impact the hotel market, the retail market in major cities, and the housing market as well. So there is that multiplier effect, or in this case, the divisor effect. There's a huge spread right now, I would say, between CRE seller and CRE buyer bids. One Twitter commentator last night, I think a strip mall guy who is very, very active on Twitter and has a lot of good insights. He was quoting somebody else, but he didn't share the person's name, but he shared the insight, which is that broker said they had never seen a bigger deviation between buyer expectations and seller asks at this point. So a lot of price discovery and perhaps more pain for landlords to come. And as we've mentioned before already, the drivers of office demand over the last 10 years, the big tech companies are all retrenching. So some positive, some negative, because is it glass half full, glass half empty? What does your gut tell you?
I think the answer is it depends. I think the tech situation is definitely going to have an impact on office and industrial, and we've seen that already. We've talked about that for the last several months. But there's some positive signs in some places, right? So Southwest had really good guidance. They say travel is back with a fury. People are traveling, and that was the same story we heard last week from United. So that has an impact on the hotel industry and people that end up traveling in places where they can spend money on services of entertainment. UPS had really good earnings story. And again, UPS, a different story than FedEx, which obviously touches a lot of different businesses. MasterCard had strong earnings, and basically what they're saying is people are traveling. They had a 44% year-over-year increase in cross-border transaction volume. So travel in Europe is back. Travel in Asia, not so much for obvious reasons, but that's good news. And the Honeywell story is a good one because they grew their building technology sales, and obviously that has an impact on commercial building industries. So there are pockets of positive news that show that there is a bounce back in some sectors that are impacted in CRE.
There's the expression in sports where they say, you're never as good as you are when you're winning, and you're never as good as bad as you are when you're losing. And I think that's what it is right now, that, some people will look at the tech earnings this week and say everything's a disaster. But to your point, Martha, there were a lot of green shoots there, particularly among the old economy. And as long as there are those green shoots and there are companies that are outperforming, the impact to the broader economy, to the workforce, hopefully will be blunted. But I will pivot very quickly to say, you started with Southwest. I never got the cattle call business plan where you show up and you're kind of herded into the plane without a seat. Like, who thought that was a good idea, right? There's JetBlue, who's going to give you a TV and a seat. And there's Southwest, who's going to prod you into your seat, kind of like sheep. Like, I just could never get my arms around this. For $50, I don't want to be prodded.
Yeah, I think the story behind that was that they could turn the planes in like 25 minutes. And when they were starting out, bootstrapped, basically, that quick turn allowed them to service as many flights as the larger airlines, which led to their profitability. Now, at this point, you could maybe say it's time to get into the modern universe and have assigned seats. But, I'll tell you, I fly frequently, as you guys know, and as much as I don't like the Southwest cattle call, it is a more efficient process than having 12 different boarding groups and people boarding and taking forever to get on the plane. So I like having an assigned seat, but I will say, like Southwest, there are some advantages to just getting everyone on there and just getting that thing up in the air.
My wife reminds me of the days when there was the budget airlines back in the 70s. Freddie Laker had one, and Continental came on. And this is not an exaggeration. This is true. You would go onto the plane with cash in hand, and a cash register would march down the aisle and take your cash. And if you didn't have cash, they'd usher you off the plane. And the flights were like $19, right? All you needed is 20 to get to it from, JFK to wherever, Orlando. It was, I don't know, that market keeps getting reinvented and they never get it right.
So a couple of weeks ago, Manus, we talked about doing some cap rate analysis, and I believe we're about to send that out next week. But if anyone had not listened to that podcast, I believe it was about 3 weeks ago, but we've got another round of details to share in this podcast. And if you want the full details, you should look for that blog to be dropped early next week.
Yes, I jumped the gun 3 weeks ago. I talked about it before all our work was done. So I got a couple of listeners really excited. They were looking forward to seeing this. And I apologize. I still had some work to do to kind of see this through. But in short, what we've done is for the last 18 months, we went back and wherever we had a sales price for a multifamily property that sold, that backed a Freddie Mac loan for which we had NOI, debt service coverage ratio, et cetera, we came up with a most recent full year cap rate to come up with just an indicator for where the market is going. We've talked about this before. Cap rate is a very nebulous notion, right? Unless you know what the revenue is that you're talking about, cap rate means nothing. Unless you know if it's pro forma, what its basis is, or if it's trailing 12 months or previous full year, right? All of that comes into play. So in our case, we looked at previous full year NOI to come up with this. It is a lagging indicator. But what we saw was that, and it's a surprise probably to no one, the cap rates have gone up, but they haven't gone up exponentially, right? We were seeing cap rates in the low threes 6 months ago. And now what we're seeing is, on average, something in the high threes with a pretty decent band, right? Anywhere from like a 360 to maybe a 490, if you were to look at the range of what we're seeing, with an average of about 395 at this point. And why do we want to put this out for people? In short, it's not the be all and end all, but in this market, if you're buying something and you have 2021 NOI numbers and 2021 debt service coverage ratio or anything else, and you're paying a 3% cap on that basis, right? You're probably overpaying, right? You may have reasons for this. You may say this is a market that's ready to explode. They have new tenants coming in, or a new industry is moving into the neighborhood. You may have a reason for paying up for this, but absent any mitigating factor, if you're paying, 310, 320 on the previous year's NOI in this market, right, it's probably a rich price to pay. And we're just trying to inform people for what the market looks like here in October 2022.
Yeah, I think the interesting other takeaway from this, and there's some nice graphics in the piece that you guys will see this next week, is if you look at, say, March of 22 through June, cap rates were still on the decline. And so it was around July where they started to pivot back up. And so our listeners have heard us talk about, the first 6 months of 22 was kind of its own, mini year. And since July forward, it's been a different market cycle. And while this data doesn't match the increase from the Fed rates, it does show a pretty stark, reality of there being additional risk or additional, cost priced into those cap rates. So I also think this acts just as a refresher that, the Fed rate doesn't directly correspond to cap rates. And so there's a misconception in the market that there's a direct correlation for some people. And the reality is, while it does have, a macro impact, it's not usually one-to-one. So I think this would indicate what we probably would have, assumed it would. But it's nice to see the raw data and the story behind it. So I think you guys will enjoy reading the piece.
While we're talking about spreads and rates and cap rates, I just want to take 2 seconds to go through, kind of what we're seeing in the market right now in terms of spread levels to help people kind of maybe complete the picture. As I said, the CMBS market is functioning. Deals are out there. They're getting priced. Trading is happening. In fact, trading volumes have been enormous. The highest level of trading we've seen in the last 5 to 10 years in terms of daily volume. We're seeing many days with north of 500 million in BWIC bid lists out for bid. Sometimes it gets as high as $1 billion. Some of that may come from overseas sellers looking to raise dollars. But just in terms of order of magnitude, 10-year AAA spreads right now, let's call it 160 basis points over the 10-year Treasury. Double A's, let's call it 240, 245. Single A's, about 300 basis points. Now, this is 10-year fixed, right? The floating rate will be a little bit different because it's shorter paper and so forth, different terms, transitional properties, but that'll give you a sense of it. On the triple B side, let's call it 450 over the curve, and triple B minus somewhere between 600 and 700 basis points over the curve, right? And that's for 10-year fixed rate paper at this point. So if people want to kind of benchmark what they might get on a loan, right? If you're talking about a triple B credit type instrument, if you're looking for funding of that, that should give you at least some parameters as to where the market resides.
So let's dig into some property sector news. Let's start with multifamily, because we were just talking about the cap rate piece, and that was actually derived from multifamily sales over the last several months. So let's start, Lonnie. We've been digging for data in our insights dashboard, and we had identified some cracks in multifamily, and that generated some questions from some of our listeners that wanted to hear more about that.
Yeah, so I would like to just start off with a few caveats to the data to say what we're calling cracks are clearly very small cracks in the foundation. So these are maybe what you would call hairline cracks because the multifamily market to date is still outperforming, is still doing really, really well. Asset to asset comparison basis is, far exceeding most of the other asset classes on the whole. So when we say multifamily starting to show some cracks, it truly is just that. We're not saying that multifamily is, in any type of a danger or that, this is an asset class you should avoid or anything like that. So, but it is interesting because over the last, call it maybe 5+ years, multifamily has been on a torrid pace, pretty much unlike any other 5-year period, maybe with the exception of just leading up to the 2007 crash. And in this case, what we're looking at in the data is I pulled together some data across the top 50 MSAs, and I looked at multifamily. So this would include all multifamily. So your garden low rise, your mid high rise, student housing, senior housing, et cetera. And so these are for active loans, loans with a current balance on them still, and arrayed them by MSA with debt service coverage less than 1. And interestingly enough, San Francisco, Oakland, Hayward MSA is the number 1 MSA with the highest debt service coverage less than 1 at about 14.7% as of today. Now, something else to consider, these numbers are reflective. So this is about 15% of the debt that we're tracking in that MSA. So, so you have some context of where the data is coming from. And some of this can be skewed by a couple of really top heavy loans if there's some really large balances in the data. But it's still a factual number. About 14.71% of the multifamily properties in the San Francisco MSA have debt service coverage less than 1. Buffalo, Niagara Falls is number 2 at about 9.51%, much smaller market, but still in the top 50. Cleveland is number 3 at 8.68%. St. Louis is number 4 at 8.27. New York, Jersey City is at 7.5 at number 5. And then Chicago, Naperville comes in at number 6 at just at 7.08%. So you have to go down to about 15th or so largest MSA before you get below 5%. So, top 15 MSAs across multifamily, there's a, pretty strong percentage, 5% or more, where debt service coverage is less than 1. Now, an interesting anecdote here would be that in the great financial crisis, if you'd seen these numbers, it would almost certainly lead you to believe that those keys are going to be coming back to the lender in some form or fashion. And that may not be the case here, where, the operators still feel these are viable. They're just having some short-term trouble. And so it'll be interesting to see how this plays out. But it does speak to the fact that maybe there are some markets where there's some cracks starting to emerge. And I know there were a couple of stories this week. Will Parker in the Wall Street Journal had a story that, talked about apartment demand. And I think he was quoted in there saying it's reached its lowest point since 2009. And the drop was worst, of any third quarter, basically in the last 30 years. And so it's really interesting to see, we're seeing a drop in demand. You have a lot of new construction projects that have broken ground in the last 24 months. So as those get, added to the inventory and you already have waning demand, logic would say that prices have to come down. And so they actually, in that story, reported rental prices started to fall for the first time in nearly 2 years on a month-over-month basis. So, we've lived in this, 5-year bubble where effectively major markets could add 10,000 new apartment units. They would just be absorbed with zero negative impact to occupancy and zero negative impact to rental rates. And I think we're maybe reaching a point where you're going to start seeing supply and demand potentially being imbalanced, and maybe the pendulum starts to swing back to the side of the renter.
So Lonnie, let me throw this out there with you. I have to think that a lot of that below 10x DSCR comes from the CRE, CLO market, stuff that was transitional, right? That they couldn't, because nobody would let a below 10x market DSCR into a conduit CMBS deal, but they would let it into a CRE. They probably have reserves in place and so forth. So now you have a situation where perhaps a guy raised his money through the CRE CLO market a year ago. He's now facing dwindling, perhaps, demand, less than expected rent growth, higher expenses to execute his business plan, higher interest rate costs, and perhaps having to fund an interest rate cap to extend the loan. So is this, on a DEFCON 1 to 5, is this DEFCON 1, DEFCON 3, DEFCON 5? What do you think this, not today, we know that it's not there today, but what does this become over time? Give us your gut feel about where this goes from here. That's a lot of headwinds.
Yeah, I think for those particular examples, like the CRE CLO, for an example, you're definitely going to have some opportunistic buying opportunities for some of those assets where, the lender's not going to be interested in extending the deal. They didn't execute the business plan. The, sponsor on the deal maybe can't raise the capital to pay for the interest rate cap or, put in cash to refi the property. They maybe can't even extend if they have extension options available because they're not meeting certain loan covenants that would qualify them to extend. So I think in that instance, there's definitely going to be some of these assets come online, available for purchase at a favorable price. What was interesting in the numbers, though, is the CRE CLO market actually only accounted for about 30 to 40% of the overall numbers. So what that tells me is there are a lot of those stabilized conduit deals that came into these loans with strong debt service coverage ratios that maybe are experiencing some downturn. And, I think, if we go back maybe 12 months, Manus, you had put a piece out around, the highly amenitized student housing and kind of the arms race that was there. And I think to a certain extent, we've seen that across conventional multi as well, where a lot of these new construction projects that have come online are very nice Class A assets. They've put pretty strong downward pressure on those older aging Class A assets. And so some of these maybe just haven't been able to sustain to the level that you would think they would. They're incurring all the expenses, but they've not been able to fully realize that rent growth. And so it'll be interesting to see. Like, I think in this example, like, you have to remember that values are up significantly, probably over when these loans were put into place. So even though debt service coverage ratios are low, and even though there may be an impairment to the value, that value may still be, and in most cases is going to be significantly higher than it was upon origination if that was 4 or 5 years ago. So I would say, I don't think this is DEFCON 5. I don't think it's even 3, but I think it's something worthy of keeping your eye on if you're an opportunistic buyer in the market. We haven't had this discussion over the last couple of years because there hasn't been any distress. This at least starts to show some signs of some potential distress.
Okay, let's turn to office. We had a couple stories we saw there.
Yeah, one green shoot. This comes from Greg Avery of the Denver Business Journal. This was an interesting story. There was a loan, a $48 million loan that was in a 2006 deal. This is a property that was solely occupied by Seagate, the chip maker. It backed a $49 million CMBS loan, took a $38 million loss several years ago. The place was fully vacant. Well, Alvarez and Marcel Capital Real Estate and Baroa Real Estate Group have lured Micron Technologies to fill almost 50% of that campus, 207,000 square feet in one of the Denver suburbs. So that's a real green shoot there for a story and a property that probably still gives the willies to some CMBS investors who saw a big loss. Some crabgrass, a couple of not so good stories. Snap joins the list of San Francisco firms giving back space. Not a lot, only about 35,000 square feet, but they are added to a roster which is now 15, 20, 25 names long. In St. Louis, this comes from the St. Louis Business Journal, Centene gave back 750,000 square feet in the St. Louis MSA, which is just an enormous amount of space for that market. It's not a huge market. And then JLL came out and said that Centene will vacate more space in the near future at 76 Forsyth Boulevard. That's a fairly new building, 27-story tower in that market. That's a real negative. And on the crabgrass side, I mentioned this before, Boston Properties and SL Green both have come out and said that the office market will remain troubling in the future in terms of higher vacancies, more subleasing, and pricing pressure going forward. So it was a week with not an awful lot of activity. A lot of the activity was smallish leases and not a whole lot of sales. So that's all I have on offices.
So let's talk about hotel. There was a story that we saw coming out of Louisville.
Yeah, so Haley Cawthorn had a story about Apple Hospitality REIT. So we might actually need to bring Stephen Bushbaum back on the pod to give us a REIT update. It's been a little while since we've had an update on the REITs, but Apple Hospitality REIT acquired an AC Hotel by Marriott, which is one of their newer brands that they brought on the market. This is in downtown Louisville, more commonly referred to as AC Hotel Nulu. So last week we had Lulu. This week we have Nulu. They acquired the hotel for $51 million, 156 keys, which was about $327 per key, and AC Hotel by Marriott Pittsburgh downtown for $34 million. That was a 134 key hotel, or about $254,000 per room. So, a couple of good stories here on the acquisition front. 300,000+ per room in Louisville, 250,000 plus in Pittsburgh.
And this last story is a regulatory story. Local Law 97, which is an initiative put in place here in New York City that aims to reduce citywide carbon emissions from large buildings. And it does have some impact on operators in this area.
Yeah, so this one refers to the law that was passed in 2019. This was part of the Climate Mobilization Act, goes into effect in 2024. So this is one of those things where building owners couldn't be concerned too much with it for the last couple of years, but now that it's right around the corner, it seems like it's top of mind for everyone. And effectively, Local Law 97 applies to any building that's over 25,000 gross square feet. We went and did an analysis. There's about 27,343 buildings that fit that criterion in New York, which account for just under 3.25 billion square feet of total space. The city's estimates are that 20 to 25% of those buildings will exceed their, allowable emission levels in 2024, which, as Martha mentioned, would result in them being fined. So we put together a really nice research report talking through the impacts of this and how that's going to be put into practice. And so that will be released here shortly. And so if you are interested in this, it definitely is going to impact the CRE marketplace. I mean, those fines are going to be directly impactful to the NOI of those buildings. There are some caveats where if you as a building owner want to buy carbon credits or offsetting credits in lieu of paying the fine, I think there's some optionality there. But this piece will give you a little more color and context on that. And if you don't see that next week, reach out to the podcast at trepp.com. We'll be happy to send that to you.
I think the bottom line there is if you're a would-be office owner in New York and you're not haircutting 2024 and on NOI by some percentage, especially if you have an older building, or conversely, driving up your expense level to account for what you have to do to retrofit these buildings, you're probably going to overpay for this asset. I mean, this is something that you can't sleep on.
And our analyst, Vivek Den-Kanikot, walked us through some scenarios with that piece. And turning to shoutouts, Zach F. in San Antonio has given us a couple of shouts recently. Rock S, interested in the maturity data, as was Jason W. Colin M. loved this week's podcast and mentioned cash in refinance. Wanted to get a little bit more info on that, so we'll have to put our team to work to give an example. Lucius C. sent to us the story of U.S. business travel. Travel revenue is back at pre-pandemic levels. So he's excited and he's going to hammer those conferences and in-person meetings personally. Mark E. tweeted that the Tony Yusuf podcast, which we had dropped earlier this week, is as good as advertised. No, even better. And great questions from the team and great data-based answers from Tony. So if you're interested in that podcast, we encourage you to give that a listen. Ken on Twitter, he says TreppWire is the best CRE podcast on the planet, which is probably the most, I don't know, effusive praise we've ever gotten.
Now we're going for the best CRE podcast in the universe. That's our next benchmark, as we're striving for.
The next frontier.
I think Ken needs a t-shirt. So Ken, we're going to be getting you a
Definitely.
TreppWire t-shirt sent out your way.
Definitely. And Solomon W responded, because I think, Manus, you were contemplating maybe sometimes we go on a little too long. He said, nope, it's short and to the point.
Well, that's good to hear.
Yeah, this is good. Ben Ching is the fan, says he loves the content. Manus, I know you had another shout out.
Yes, this is a heartfelt one. This goes out to Joel and Skylar on Long Island. So Joel is a CMBS guy. He's been in the market for about 15 years, podcast listener. We had a chance to golf this summer. Great guy. This might be damning him with faint praise, but he probably knows more about CMBS than I do. But a great guy. Skylar is his son. I would say Skylar is probably 14 or 15. Between the two of them, they just did a fundraiser for the Children's Hospital of Philadelphia and raised 130 grand.
Wow.
And I just wanted to give a great shout out that even though we're all about CRE and CMBS, and sometimes we lose sight of the bigger picture, that there's this whole bigger world out there that's going on. Sometimes we forget about that. And kudos to Joel and Skylar for looking at the bigger picture, raising all this money. And this time next year, I'm going to make sure to promote this before the event so that we give it even more love to those guys going forward. So attaboy to the two of you. Very
cool. And you said world, which of course made me think, of course, World Series. Key Lime Johnny, who has been our resident Philly fan, is no doubt going to be rooting for the Phils tomorrow night when the World Series begins, where the Phils are playing the Astros. And, you know, if you remember, he was the first one that said when the Phillies have won the World Series, the economy went bust. And that turned out to be a headline in one of the Axios newsletters this week. And I'm like, well, he said it first.
Yeah, it's good for Key Lime Johnny. He's a nice guy. You know, his cup runneth over. He's a Buccaneers fan. They got the Super Bowl a couple of years ago. He might get a World Series this time, but, you know, I got to say, you know, I'm a Met fan. So had it been a Phillies-Yankees World Series, you know, I would have been rooting for like an asteroid hitting the earth or something like that, right?
Wow.
Something, you know, something more pleasant than a Yankees-Phillies World Series.
That's rough. And Susie S. actually gave me a box of candy cigarettes after her client had them sitting around the office. And of course, she listened to last week's pod where we were talking about fake cigarettes and the candy associated with those, you know, those fake ones where you kind of puff on them and end up eating them. They're either gum or candy. Apparently, they're still handing them out somewhere.
Susie, up your game, girl. Please go out and get some Almond Joys or some Reese's
Exactly.
peanut butter cups. No raisins, no candy cigarettes, no Clark bars.
No.
Come
And
on.
apparently, according to data, Americans eat about 3.5 pounds of candy over the Halloween holiday. So you better get started and don't send me any of those cigarettes. And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.